Okay, so this report lays out a really bullish short-term volatility trade on BYND meat.
Right, the BYND short squeeze thesis.
Exactly. You've got high short interest, a massive days to cover ratio, but it's all complicated by this huge recent share dilution.
And that central tension, the tug of war, as they call it, is a great foundation, a really strong starting point.
It is. So let's jump right in there by tightening up what I think is the core structural weakness of the thesis.
The timeline.
The timeline.
To really elevate the core tension of this trade, the report has to explicitly integrate the timeline of that dilution event with the actual squeeze mechanics.
You can't really have a powder keg setup if you don't know when the powder gets wet.
That's a perfect way to put it, and the weakness right now is that the whole thesis relies on this liquidity crunch happening before the new shares hit the market.
But there's no hard timeline. We don't know when that share count, which might have, ballooned 5x, is actually going to hit.
It makes the central premise feel more like a guess on timing than a confirmed schedule.
So the suggestion is pretty straightforward, right? Pin down the known or estimated date range for that dilution release.
It would give the thesis a verifiable expiration date.
And that would massively boost the credibility of the whole imminent squeeze argument.
Yeah. For instance, you could use that date as your hard deadline.
And then from there, calculate how many days of average volume it would take for that 10 to 14 days to cover ratio to clear out the shorts.
If a catalyst hits within that window.
Right, like holding the psychological $1 level or breaking $1.15. It creates a concrete window for the trade.
Okay, so that handles the hard deadline. How do we make the potential payoff, that GME parallel, more concrete?
I think we need to strengthen the comparison to GME by translating the days to cover metric into a requirement for estimated retail volume.
Exactly, because right now, the parallel rests mostly on sentiment.
Yeah, brand recognition, a lotto ticket narrative on Wall Street bets, that kind of thing.
And while 10 to 14 days to cover is huge,
It's massive.
the report doesn't really quantify how rapidly retail interest would need to accelerate volume to actually force shorts to panic.
Especially against the 26% cost to borrow.
So the suggestion is to use the days to cover data as more of a predictive tool.
Make the data work harder.
Yes, estimate the necessary exponential increase in volume that you'd need to collapse that squeeze window from 2 weeks down to just a few days.
So instead of just saying it's massive, you state the exact daily average volume needed to maintain that 1014 DTC.
And then calculate the multiple. Is it 5x? Is it 10x current retail volume?
That would be needed to drop the DTC ratio to, say, 2 days. It provides a really clear quantitative goal for the rocket fuel.
I like that. So that defines the upside. Now let's talk about the risk floor.
The verdict section. It could be sharpened by clearly articulating the immediate consequence of breaching that critical support level.
And linking it back to institutional risk.
Because saying a break of $1 sends the stock to penny stock purgatory it's too abstract for this kind of high-impact thesis.
Right. The key weakness is we need to clarify why institutional funds would be forced to sell.
Yes. Why would that confirm the dominance of the dilution thesis over the squeeze?
So the suggestion is to define that actionable consequence of failure.
Explain that large institutional funds often have mandates preventing them from holding stocks priced below, say, $1 or 50 cents.
And so breaking that $1 level acts as a hard confirmation that the dilution side of the tug of war has won.
And that's what triggers the algorithmic cascade of selling, which goes far beyond just standard bear pressure.
That's the hard risk floor you need to define. It becomes mechanical at that point.
So we focused on 3 key areas today. First, integrating that dilution timeline.
Second, quantifying the mean parallel by calculating required retail volume.
And last, sharpening the consequence of failure by explaining that institutional sell-off trigger.
Implement these changes and you'll really reinforce the structural robustness of the argument.
Specifically, nail down that dilution timing and use your strong DTC data to do the math on the volume. We look forward to seeing the revised research.